Right now, at this exact moment, while you're watching this, silver just breached $97. But here's what they're not telling you. In Dubai, physical silver is trading at $127 per ounce. COMEX paper contracts still showing $73. That's a $54 gap. Something is fundamentally broken. China just restricted exports. COMEX hiked margins overnight. And institutional money moved 3 months ago. The question isn't if we hit $100 tonight. The question is, what happens to those who didn't see this coming? Welcome to Currency Archive. If you've been in business long enough to remember when a handshake meant something, when markets actually reflected reality, when silver was honest money, then you already know something's deeply wrong here. We don't do entertainment, we do intelligence. The kind your broker won't give you, the kind that costs institutional clients 6 figures annually. If that sounds like the analysis you've been searching for, the channel that doesn't insult your experience, hit that subscribe button below and tell us in the comments, where in the world are you watching this from right now? Because what's happening in silver markets tonight affects every business owner, every serious investor, every person who understands that currency is archive. Now, let's talk about what's really happening. The clock struck 8:00 p.m. Eastern Standard Time on January 22nd, 2026. In Tokyo, the Asian markets opened for trading, and something unprecedented happened. Silver broke through $97 per ounce, then $98, then $19. For the first time in recorded history, silver was crushing toward the $100 barrier. But this wasn't just another price spike, this was something far more significant. Traders across the globe stared at their screens in disbelief. The charts showed something that shouldn't be possible in a functioning market. In Shanghai, physical silver was trading at $110 per ounce. On the COMEX in New York, paper silver contracts showed $98, a $12 gap. In Dubai, the situation was even more extreme. Physical silver dealers were quoting $127 per ounce, while Western paper markets lagged behind at $73. This wasn't a pricing discrepancy. This was a complete breakdown of the global silver pricing system. For decades, silver prices moved in lockstep around the world. Arbitrage traders made sure of it. When prices diverged between markets, they would buy low in one location and sell high in another. This natural mechanism kept global prices aligned within pennies of each other. But on this night, arbitrage had died. The mechanism that had maintained silver's fungibility across continents had simply stopped working. Physical silver was trading at one price, paper contracts at another, and the gap kept widening. Experienced market analysts recognized what they were witnessing. This wasn't volatility, this wasn't speculation, this was structural failure at the foundation of precious metals pricing. The COMEX, the world's largest silver futures exchange, showed massive backwardation. Futures contracts for delivery months ahead were trading cheaper than spot prices. Historically, this signals one thing: severe physical shortage. When traders are willing to pay more for silver today than silver promised for delivery next month, it means the market is screaming for physical metal right now. The delivery notices at COMEX hit record levels, vault inventories drained, and the premiums for physical silver over paper contracts reached levels never seen before. Not in 1980, not in 2011, and not ever. The mathematical impossibility of the current situation became clear to anyone paying attention. If silver in Shanghai costs $110 and silver in New York costs $98, someone should be buying in New York and selling in Shanghai for an instant $12 profit per ounce. Multiply that by thousands of ounces and the profit becomes enormous. But it wasn't happening. Why? Because physical silver wasn't available in the quantities needed to execute the trade. The paper markets showed one price, the physical markets showed another, and the bridge between them had collapsed. Corporate treasuries that relied on silver for manufacturing suddenly faced a crisis. Electronics companies, solar panel manufacturers, medical device producers, they all needed physical silver, not paper promises, and physical silver was disappearing. The overnight gap risk became obvious. Anyone holding paper silver contracts faced a terrifying possibility. What if they showed up to take delivery and the silver simply wasn't there? This price level represented more than just a milestone. It represented an institutional panic threshold. When physical premiums exceed 30% above paper prices for an extended period, history shows what follows. Either the paper price rises dramatically to meet physical reality, or the paper market loses all credibility. And tonight, the world was watching which outcome would unfold. Gold wasn't sitting idle either. It had just made its own all-time high at $4,166.99 per ounce, only $33 away from the psychological $5,000 barrier. The gold to silver ratio plummeted to 50.33 ounces of silver to 1 ounce of gold. Everything was moving. But silver's movement carried a different message. Gold's rise suggested monetary concerns, inflation fears, currency devaluation worries. Silver's explosion suggested something more urgent: supply chain breakdown. The manufacturing sector watched with growing alarm. Silver isn't just an investment metal, it's the most conductive element known to science, the most reflective, essential for electronics, solar energy, medical equipment, and countless industrial applications. And the world produces about 835 million ounces annually while consuming over 1.2 billion ounces. 5 consecutive years of deficit. Peak mining production occurred in 2016. Every year since, production has declined 1% to 3%. Building new mines takes 10 to 15 years. There's no quick supply response coming. This wasn't 1980 when the world produced surplus silver. This wasn't 2011 when mines could ramp up production. This was 2026, and the deficit was structural. As silver approached $99.50 per ounce, traders prepared for what might come next. Would it break through $100 tonight? Would gold hit $5,000 first? But the more important question loomed larger. This price movement wasn't isolated. It wasn't random. It was the visible symptom of invisible stress building throughout the entire global monetary system. Something had triggered this convergence. Something specific. Something that happened in the hours and days before this moment that set the stage for what traders were witnessing right now. And understanding those catalysts would reveal whether this was just beginning or approaching its climax. 3 separate events, 3 different continents, all converging in the same 48-hour window, none of them accidents. The first domino fell in Beijing. On January 20th, 2026, China's Ministry of Commerce issued an emergency directive. Effective immediately, all silver exports would require special governmental approval, no exceptions, no grandfather clauses for existing contracts. The announcement came at 2 a.m. Beijing time. Most Western traders were asleep when it happened. By the time New York opened, Asian markets had already absorbed the shock. China controls approximately 18% of global refined silver production. But more importantly, China serves as the processing hub for silver mined across Asia and parts of Africa. The restriction didn't just cut off Chinese silver, it bottlenecked the entire Asian supply chain. Within hours, physical silver dealers in Singapore, Dubai, and Hong Kong began raising premiums. Corporate buyers who relied on Chinese supply scrambled to secure alternative sources. Electronics manufacturers in Japan and South Korea faced immediate procurement crises. But the restriction revealed something more significant than supply disruption. It revealed positioning. China didn't wake up one morning and randomly decide to restrict silver exports. This decision came after months of internal preparation. State-owned enterprises had been quietly accumulating physical silver throughout 2025. Domestic refineries had been prioritizing local customers over international orders. The pieces were in place before the announcement. Someone knew this was coming, and they positioned accordingly. The second domino fell in New York. Just 18 hours after China's announcement, the COMEX made its own stunning move. Margin requirements for silver futures contracts increased from 8% to 14%, a 75% increase implemented with only 24 hours' notice. The stated reason was routine risk management. The timing suggested something else entirely. Margin hikes force traders to deposit more cash to maintain their positions. When margins increase suddenly, traders face a choice: either deposit more capital or liquidate positions. Many choose liquidation. The mathematical impact was immediate. Approximately 240,000 silver futures contracts were outstanding when the announcement came. Each contract represents 5,000 ounces. That's 1.2 billion ounces of paper silver exposure. With the margin increase, traders collectively needed to deposit an additional $840 million within 24 hours to maintain their positions. Most didn't have it. The liquidation cascade began. But here's where it gets interesting. Normally, when leveraged traders liquidate futures positions, prices fall. Forced selling creates downward pressure. That's how margin hikes traditionally work. They cool overheated markets by forcing speculators out. But silver didn't fall, it rose. This meant the liquidations were primarily short positions. Traders who had bet against silver were being forced to buy back their contracts at higher prices. Each forced buy pushed prices higher, which triggered more margin calls, which forced more buying. A short squeeze was building, and the timing of COMEX's margin hike, right after China's export restriction, meant maximum pressure on those caught short. The third domino fell in Dubai. The world's physical silver hub began reporting something unprecedented. The traditional arbitrage mechanism had stopped functioning. Dealers in Dubai were quoting physical silver at $127 per ounce, while COMEX futures showed $73, a $54 gap. Under normal market conditions, this gap would last minutes, maybe hours. Arbitrage traders would flood in, buy cheap COMEX contracts, take physical delivery, ship to Dubai, sell at premium, pocket the difference. Simple, profitable, guaranteed. Except it wasn't happening. The COMEX vaults didn't have enough physical silver to deliver against the contracts being presented. Delivery times stretched from days to weeks. Shipping costs and insurance premiums skyrocketed. And by the time a trader could actually get physical silver from New York to Dubai, the prices had moved again. The death of arbitrage meant something profound. It meant silver was no longer fungible across global markets. A silver coin in New York and a silver coin in Dubai should be worth the same amount. That's what fungibility means. But when physical availability diverges between regions, prices disconnect. And once prices disconnect, trust evaporates. Now examine the sequence. China restricts exports on January 20th. Supply tightens. COMEX hikes margins on January 21st. Shorts get squeezed. Dubai's arbitrage breaks down on January 22nd. Price discovery fails. Each event amplified the others. The export restriction made physical silver scarce. The margin hike forced desperate buying. The arbitrage failure prevented equilibrium. But the most revealing detail wasn't what happened. It was who moved first. Certain institutional players had increased their physical silver holdings 3 months earlier. Mining companies locked in forward sales at what seemed like attractive prices in October 2025. Sovereign wealth funds quietly rotated into precious metals in November. The analyst predictions started appearing in December. By early January, the sophisticated money had already positioned. They saw the convergence coming. While retail investors watched entertainment news and checked their portfolios casually, institutional capital was reading different signals. Monitoring Chinese policy discussions, tracking COMEX vault inventories, calculating arbitrage spreads. They knew, and they moved, which raises the uncomfortable question. If some knew this was coming, what else do they know that hasn't happened yet? September 2025, 4 months before silver crushed $97, a research report landed on the desks of select institutional clients. The title was unremarkable. Precious Metals. Quarterly Review, Q3 2025. Page 47 contained 3 sentences that would prove prophetic. Chinese export policy appears increasingly protectionist regarding strategic materials. COMEX vault dynamics suggest structural delivery stress by Q1 2026. Physical paper disconnect probability 78% within 6 months. The report cost $125 annually to access. Retail investors never saw it. By October 2025, something curious began happening in the physical silver market. Corporate treasuries at companies nobody would associate with precious metals. Speculation started making unusual purchases. A semiconductor manufacturer in Taiwan bought 500,000 ounces of physical silver, 3 months of forward inventory instead of their normal 30-day supply. A solar panel company in Germany secured 1.2 million ounces through fixed-price contracts extending into 2027. A medical device producer in Massachusetts quietly stockpiled 800,000 ounces. These weren't investment plays. These were companies treating silver as a critical input facing imminent supply disruption. They weren't speculating on price. They were insuring against unavailability. The difference is crucial. When manufacturers secure excessive inventory of a commodity they actually consume in production, it signals something different than financial speculation. It signals they've received intelligence about supply chain breakdown, and they had. The same institutional research, circulating through private wealth management firms and sovereign wealth funds, had reached corporate risk management departments. Different format, same conclusion. Silver availability was about to become a problem. Meanwhile, retail investors scrolled through social media. They watched entertainment personalities discuss stock market predictions. They read headlines about technology companies and cryptocurrency. They checked their retirement accounts quarterly and assumed their financial advisors were watching everything important. Silver was barely mentioned. The information asymmetry was staggering. While institutional clients read 300-page commodity reports analyzing Chinese provincial export data, retail investors got their information from free YouTube videos and financial news networks running commercials for gold dealers. While corporate treasuries attended private briefings on COMEX delivery mechanics, retail investors watched talking heads debate whether silver might reach $30 someday. While sovereign wealth funds modeled scenarios for physical paper market disconnection, retail investors wondered if they should buy a few coins for emergency savings. The intelligence gap wasn't just about information access, it was about interpretation. A retail investor looking at COMEX vault inventory data in October 2025 would have seen numbers that seemed adequate. Approximately 285 million ounces in registered vaults. Plenty of silver. An institutional analyst looking at the same data saw something different. They saw the ratio of open interest to available inventory. They calculated delivery rates versus replenishment rates. They tracked which specific vaults were gaining or losing metal. They knew which institutions were taking physical delivery versus rolling contracts forward. They saw stress building. Same data, different conclusions. By November 2025, the analyst predictions started appearing in institutional circles. Silver to triple digits within 12 months. private research firm, November 8, 2025. A physical silver supply crisis probable by Q1 2026. Sovereign Wealth Fund internal memo, November 15, 2025. COMEX delivery system at structural breaking point. Banking sector risk assessment, November 22, 2025. None of these reports appeared in mainstream financial media. Retail investors remained unaware. December 2025 brought the positioning phase. Sophisticated capital doesn't wait for certainty. It acts on probability. When multiple independent analyses reach similar conclusions about an emerging structural problem, institutional money moves. Not all at once. That would alert the market. Gradually, quietly, strategically. A pension fund allocates 2% of assets to physical precious metals. Unremarkable. A family office buys 50,000 ounces of silver through private transaction. Invisible. A hedge fund takes delivery on COMEX contracts instead of rolling them forward. Routine procedure. Individually, these actions meant nothing. Collectively, they represented massive positioning ahead of an anticipated event. And then January 2026 arrived. China announced export restrictions. COMEX hiked margins. Dubai's arbitrage broke down. Silver exploded from $73 to $99 in 48 hours. Retail investors were shocked. How did this happen so fast? Nobody saw this coming. This is unprecedented. Except it wasn't unprecedented. And people did see it coming. Just not the people watching financial news networks or checking their portfolios once a month. The psychological trap of validation seeking had caught retail investors again. They waited for mainstream confirmation before acting. They needed CNBC to discuss it. They needed their financial advisor to recommend it. They needed their neighbor to mention it at a barbecue. By the time information reached that level of consensus, the opportunity had passed. The sophisticated money had already positioned 4 months earlier at $73 silver. The retail money arrived at $99, asking if it was too late to buy. This pattern repeats throughout financial history. Institutional capital operates on research, analysis, and probabilistic thinking. Retail capital operates on confirmation, emotion, and reactive behavior. The former anticipates structural changes. The latter responds to price changes, and the cost of that difference is staggering. But price movement was only the beginning. What happened next would separate those who understood second-order effects from those who simply watched numbers go up. The champagne bottles remained unopened. Silver sat at $99.30 per ounce, just 70 cents from the psychological $100 barrier. But something more significant was happening beneath the surface, something most traders weren't watching. In Shenzhen, China, a solar panel manufacturing plant received an emergency notification from their procurement department. Silver paste delivery scheduled for February 3rd had been canceled. No alternative supplier available. Production line shut down imminent. In Stuttgart, Germany, an automotive electronics manufacturer discovered their silver contact supplier couldn't fulfill March orders. The supplier hadn't gone bankrupt. They simply couldn't source the physical metal. In Boston, Massachusetts, a medical device company learned their conductive silver ink shipment was delayed indefinitely. Their production schedule for cardiac monitoring equipment faced immediate disruption. These weren't financial market problems. These were real economy consequences. The manufacturing sector cascade had begun. Silver isn't optional in modern electronics. It's not a preference. It's a necessity dictated by physics. Silver conducts electricity better than any other element. It reflects light better than any other element. It transfers heat better than any other element except diamond. You cannot substitute aluminum and maintain the same performance. You cannot substitute copper and achieve the same conductivity. You cannot substitute gold and keep costs remotely competitive. Silver is irreplaceable in thousands of applications, and now it was becoming unavailable at any price in certain markets. The corporate profit margin compression mathematics became brutal. A solar panel manufacturer using 20 grams of silver per panel faced a simple calculation. At $73 silver, that's $47 in material cost per panel. At $99 silver, that's $64 per panel. A $17 increase doesn't sound catastrophic until you multiply it by 10 million panels annually. That's $170 million in additional costs that didn't exist 48 hours ago. Now the strategic decisions began. Absorb the cost and destroy profit margins, pass it through to customers and lose market share, redesign products to use less silver and risk performance degradation. None of these options were good. All of them were necessary. But the manufacturing cascade represented just one contagion pathway. The financial markets faced their own secondary crisis. Silver derivatives exposure across the global banking system started revealing itself. When silver moved $1, certain derivative positions gained or lost millions. When silver moved $26 in 48 hours, those positions faced catastrophic stress. The banks holding short positions in silver derivatives weren't just facing losses, they were facing margin calls that exceeded their allocated risk capital. Counterparty risk emerged. If Bank A owed Bank B $400 million on silver derivative contracts and Bank A couldn't post collateral, what happened to Bank B's balance sheet? The correlation breakdown began spreading. Historically, when silver rises dramatically, certain other assets move in predictable patterns. Gold rises, the dollar falls, treasury yields shift, equity markets react. But this time, the correlations weren't holding. Gold was rising, but not as fast as silver. The dollar was falling, but not as much as models predicted. Treasury yields were moving erratically. The normal relationships that institutional traders used for risk management and hedging strategies were breaking down. Portfolio insurance strategies built on historical correlations suddenly provided no insurance at all. Volatility indicators across multiple markets began flashing warnings, not just in precious metals, currency markets, bond markets, commodity markets. The stress was spreading through the entire financial system like cracks spreading across ice. And then the question emerged that nobody wanted to ask out loud. What does triple-digit silver signal about dollar confidence? Silver reaching $100 per ounce wasn't just a commodity story, it was a monetary story. Throughout history, dramatic precious metals appreciation has coincided with currency devaluation concerns. When people lose faith in paper money, they flee to tangible assets. Silver hitting $100 suggested something profound about global monetary confidence. Central banks noticed, currency traders noticed, sovereign wealth funds noticed. The strategic positioning framework shifted. For business owners, the question was no longer, should I invest in silver? The question became, how do I hedge input costs under supply uncertainty? For capital allocators, the question wasn't, is silver overvalued at $99? The question became, what percentage of assets should be in physical versus paper exposure? For corporate treasuries, the question wasn't, will silver prices fall back to normal? The question became, how much inventory should we stockpile before availability disappears completely? For investors, the question wasn't, should I buy some silver? The question became, do I understand the difference between owning a contract and owning the metal? The overnight risk assessment became critical. Every hour silver remained near $100. The probability of a gap through that level increased. Technical resistance at round numbers like $100 creates enormous pressure. Price either breaks through decisively or collapses under profit-taking. There's rarely a middle path. Historical precedent from previous precious metals, structural breaks offered clues. In 1980, silver gapped from $48 to $50 overnight, then collapsed within days. In 2011, silver climbed to $49.82, failed to break $50, and fell 30% within 2 weeks. But 2026 was different. This wasn't a speculative bubble. This was a supply crisis. The fundamental deficit was real. The manufacturing demand was real. The geopolitical restrictions were real. This wasn't driven by speculation. It was driven by scarcity. And scarcity doesn't resolve overnight. The final strategic warning crystallized. This wasn't about trading price movements. This was about recognizing system reconfiguration. The global silver market had operated under specific assumptions for 45 years. Those assumptions had just been invalidated in 48 hours. When fundamental market structures break, they don't repair quickly. They rebuild slowly, or they rebuild differently. The question facing every business leader, every investor, every decision maker was no longer academic. It was immediate. Are you positioned for the world that existed last week, or for the world that exists right now?